Imagine this: you own a piece of a massive, profitable company, and every 3 months, like clockwork, it sends you a check in the mail just for being an owner. No, this isn't a fantasy or a get-rich-quick scheme. This is the reality for millions of investors who own dividend stocks. But what exactly are they? How does this money just appear in your brokerage account? And is this magical-sounding income stream too good to be true? If you've ever been confused about how dividends work, you're in the right place. Today, we're going to demystify dividend stocks completely. We'll explain what they are, why companies share their profits with you, and how you can use them to build a powerful stream of passive income that can eventually help pay your bills. This is one of the most reliable wealth-building strategies in the history of the stock market, and by the end of this video, you'll understand exactly how to harness it. Let's start with the absolute basics. A dividend is simply a payment that a company makes to its shareholders out of its profits. It's your share of the company's earnings. Think of it like this: if you and a friend own a small pizza shop that made a profit of $10,000 this year, you might decide to each take $5,000 home. That's your dividend. A publicly traded company does the exact same thing on a much larger scale. When a company is profitable, its board of directors can decide to do one of two things with those profits. They can reinvest all of it back into the business to fund new projects, research, and expansion. This is what most young, fast-growing tech companies do. Or, if the company is more mature and already highly profitable, they can decide to share a portion of those profits with the owners. That's you, the shareholder. The payment is almost always made in cash and deposited directly into your brokerage account, and it's almost always paid on a regular quarterly schedule. So, a dividend stock is simply the stock of a company that has a policy of regularly sharing its profits with its shareholders. Now, why would a company willingly give away its profits? It seems counterintuitive, right? The reason is that paying dividends attracts a certain type of long-term, stable investor. Companies that pay consistent dividends are often seen as mature, financially healthy, and confident in their ability to generate steady cash flow. It signals to the market that the business is not just profitable, but predictably so. For many large companies in established industries, think consumer staples like Procter & Gamble, utilities like Southern Company, or big oil companies like ExxonMobil, their growth phase is largely behind them. They don't need to reinvest every single dollar of profit back into the business. So, instead of sitting on a giant pile of cash, they return it to their owners, making their stock more attractive. This creates a virtuous cycle. Reliable dividends attract loyal shareholders, which stabilizes the stock price, which allows the company to continue its operations and strategic plans with confidence. It's a way of rewarding shareholders for their patience and faith, without them having to sell a single share. To truly understand how to invest in dividend stocks, you need to speak the language. There are 3 key terms you must know. The first is dividend yield. This is the most commonly quoted metric, and it tells you the annual dividend income you can expect relative to the stock's price. It's calculated by taking the annual dividend per share and dividing it by the current share price. So, if a stock pays $4 in dividends per year and its share price is $100, its dividend yield is 4%. A crucial pro tip here is to be wary of very high yields. A yield that seems too good to be true often is. It can be a sign that the stock price has crashed because the market believes the dividend is in danger of being cut. The second key term is the payout ratio. This is a critical health check. It tells you what percentage of the company's earnings is being paid out as dividends. If a company earns $5 per share and pays a $4 dividend, its payout ratio is 80%. Generally, a lower payout ratio, say below 60%, is safer. It means the company is retaining plenty of cash to reinvest in the business and can easily afford the dividend, even if earnings dip slightly. A payout ratio over 100% is a major red flag. It means the company is paying out more than it earns, which is unsustainable. The third term is the ex-dividend date. This is the most important date on the calendar. To be eligible to receive a dividend, you must own the stock before the ex-dividend date. If you buy the stock on or after this date, you won't get the upcoming payment. It's the cutoff point for ownership. Now, let us talk about the engine that makes dividend investing so powerful over the long run, compounding through a dividend reinvestment plan, or DRIP. When you receive a dividend, you have a choice. You can take the cash and spend it, which is fine for those using it as income in retirement. Or, you can tell your broker to automatically reinvest that cash to buy more shares of the same stock, often without paying a commission. This is the secret weapon. Let's say you own 100 shares of a stock that pays a quarterly dividend. That first payment comes in, and it automatically buys you one more full share. Now you own 101 shares. The next quarter, you get a dividend payment based on 101 shares, which buys you slightly more than one share. This cycle continues, and over time, you are accumulating more and more shares without ever investing another dollar of your own money. The number of shares you own begins to snowball, which means the dividend payments get larger, which buys even more shares. Over decades, this compounding effect can be staggering. It's a way of putting your portfolio on autopilot, forcing it to grow by constantly buying more of a productive asset. Before we wrap up, it's crucial to discuss the pros, cons, and a strong disclaimer. The advantages of dividend stocks are clear. They provide a passive income stream, they tend to be less volatile than growth stocks, and the power of compounding through reinvestment is immense. However, there are downsides. Dividend stocks can grow more slowly than aggressive growth stocks. The dividends are also typically taxed as ordinary income in the year you receive them, unless they are in a tax-advantaged account like a Roth IRA. And perhaps the biggest risk is a dividend cut. If a company falls on hard times, the board can reduce or eliminate the dividend, which will not only reduce your income but often cause the stock price to plummet. Now, for the critical disclaimer. Chasing high dividend yields is a very risky strategy. A high yield is often a trap, signaling a company in distress. All investing involves risk, including the loss of principal. This video is for educational purposes only and is not a recommendation to buy any specific stock. You must conduct your own thorough research or consult with a qualified financial advisor. Building a dividend portfolio is a long-term strategy, not a short-term income hack. To bring it all together, dividend stocks represent ownership in mature, profitable companies that share a portion of their earnings with their shareholders on a regular basis. You can evaluate them by looking at their yield, payout ratio, and track record. By reinvesting those dividends automatically, you harness the incredible power of compounding to build significant wealth over time. It's a strategy built on patience, discipline, and a focus on steady cash flow. It's not the flashiest path, but for millions of investors, it's the most reliable one. So, the next time you see a company with a dividend, you'll see more than just a yield percentage. You'll see a business sharing its success with you, its owner. Now, I'm curious, does the idea of passive income from dividends appeal to you more than the potential for rapid growth? Let me know in the comments below. Thanks for watching. And I'll see you in the next one.